Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about market news. We're going to talk about how the portfolio is doing. We'll give you an update on that. We'll talk about whether I'm buying, whether I'm selling, and we'll just get right into it. So if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So today the portfolio closed out at $11,553.99. We are currently down in the market, $178.55. Not in the market, but in this portfolio, we are also down 1.52%. As you can see, it's just trending down. For the 1 week, we are down $410.59, down 3.43%. For the 1 month, we're down $553.20, down 4.57%. For the 3 months, we are down $219.27, down 1.86%. For the year, we are up $1,058.53, up 10.09%. And for the all, we are up $1,715.47, up 17.44%. As you can see here, all the positions were red today. We have $70.60 in the cash account with $100 that is hopefully heading in there. And we also have companies on the watch list that you can see are down as well. We are down on average quite a bit here. Looks like anywhere from $6 to $2, and it just keeps on going. So red days don't mean dead days, okay? And so there has been a lot of news going on, but not really pertaining to what's going on in the marketplace, but just individual news. As we know, Elon Musk has been approved to complete that deal of purchasing almost 9% of Twitter, which I don't know if is, I don't think it's a bad thing. I think it's actually a good thing with the way that Twitter was going. We have other news as well as earnings season that's happening. Netflix being one of the big tech companies that came to report their earnings. And as a lot of people know, they have had a $200,000 net subscriber loss. Now, that's not a bad thing. I know they talked about they're heading towards a 2 million net loss in subscriber counts, but the 200 was kind of an off number because this company's so used to having a net positive with subscribers. They would have had I think it was like a 700,000 net subscriber positive, but with the things that are happening on the other side of the world, they had to take out like a million subscribers, which caused them to have a net loss. But they are projecting to have anywhere upwards of 2 million net subscriber loss. And so they are looking at other avenues to produce an income, which means potentially adding ads onto that platform. Now, is that a bad thing? It's a common thing. If you're in the tech industry for long enough, you will eventually be selling ads. It's very apparent if you look at Instagram, ads everywhere. Facebook, ads everywhere. You look at, what's another one? Not Instagram, but yeah, there's ads everywhere. If you've been in the tech industry for long enough, or the business has been around long enough where there's not a lot of overhead, but Netflix does have a lot of overhead, you will eventually be selling ads. And that's just the way it is. You look at Google, you look at YouTube, they all have ads. We all know this. And it's just going to happen. It's another source of income. It might not be the greatest source of income, but they have to do something to mitigate the amount of losses they are going to incur over time with all these losses and churning with subscribers. And so just to give you feedback on that, because it has been the talk, because the market, there's not a lot to talk about as of right now. Just the market keeps on doing its thing, going down. And I don't think it's a bad thing, to be honest. And so am I buying? Am I selling? I'm going to continue to buy positions. And I think a lot of new investors should. Now, this is not financial advice. Use your own discretion. Do your own research. This is the time where you will probably see a lot of good valued companies go down in stock price. I mean, you look at Starbucks, which is on my watch list. This one almost hit $100 at some point. Or I think it did. Yeah, it was like over $100 a share. And in the company there for a time that I can't remember how long ago it was, but the CEO had to step down. I think just due to retirement. And in the interim, the board is just figuring out what they need to do and who's going to be the next CEO of Starbucks. Now, if you don't know, the original founder of Starbucks is in the time being becoming the CEO in that time frame. So it had like a 5% increase, but you look at these companies, and as they go down, Home Depot, another one, which is a fantastic company that I hope to purchase in the future, which because I don't own any shares. You can see that they're down from their highs. A lot of it's down from a lot. Like, I mean, this is over the year now, a 34% drop in Starbucks. That could possibly be a great deal if I go and do my research, and might be the next position that I buy, you know, from $100 or over $100 down to 70. For me, that's a good deal. And even though the markets are down, don't try to time it where you can find the perfect bottom to make these position moves. Buy them now. Again, not financial advice, just entertainment purposes only. For myself, buy it now or buy in the near future. And as it continues to drop, if it does, that's even a better deal. And I continue to use that strategy of dollar cost averaging that we've talked about before. And so is it something to be panicked about? Not really, not in my opinion. I think this is where you start seeing actual good deals, or even times where companies were maybe overvalued coming back down to a regular price. And if you bought at a premium, now you can bring your average down. Now, how does this pertain to dividends? Because we are focused pretty much on dividends in this portfolio. As stock prices go down, dividend yields go up because it's a percentage based off the stock price. Now, is that a bad thing? Not really. You're just getting a better return on your investment. So let's say BMO, for example, currently the dividend yield is 3.19%. If that stock price keeps going down, you can expect the dividend yield to go up because you are getting more for your investment. And eventually, when the market does return, or any stock returns, you'll be able to capitalize on that dividend yield. You'll be able to capitalize on those gains because you're bringing your dollar cost average down. And it's just a good help boost to your portfolio. Now, I'm not panicking at all. It kind of hurts, but to see this, but we've been through it before. For newer investors, maybe not. This is something that's maybe lasting a bit longer, because a lot of new investors started investing during the 2019, 2020 era, where we had kind of a really sharp downturn, but a really sharp return. And for the past 3 years or 2 years, 2.5 years, all they've seen is complete, utter gains. And yeah, I mean, now you're facing it. Now you will feel what a lot of people may have felt in the past and know how to capitalize on that, because wealth is built mostly in the times where there is downturns, and it just makes sense because they just keep on dollar cost averaging down, which I will continue to do. I haven't sold any positions, and never will I probably do that. Now, in the near future, I am building my stockpile because I am looking forward to purchase some Google shares, probably post-split, not pre-split, because it's a position that I've wanted to build for a long time. And I think this would be a good opportunity for that. Now, a lot of people may be thinking the other stuff that's going around is, are we in a recession? We won't know until after the recession has passed, or we are in the middle of it, because typically a recession is 2 quarters of negative GDP, and that would be considered a recession. Now, GDP numbers, real GDP numbers, don't come out till after the fact. And so that's why we never know if we're in a recession currently. It may feel like it. If you recognize it, then maybe not. I just feel that the market is just tired. And I think everybody is tired. You know, when you have those types of gains, or the couple years that we've had, the great couple of years that we have had, or the past 10 years that we've had in great growth, you get tired. I mean, imagine running a marathon for so long. Eventually, you're going to get tired. I get it. You got to pace yourself and things like that. But I think the market is just exhausted. It's taking a break. It'll just get back to what it's used to after that little break. Now, investing is not something you can time. I just want to put that out there. Remember, this is a paced investment. You just keep on doing what you're doing. Don't panic. Just slowly keep on contributing your amounts. Keep on purchasing over time. It'll just make sense. And it'll slowly build your way to wealth, slowly build your dividend portfolio to what a lot of people are chasing is financial freedom, or financial independence, where you don't have to rely on active income, but just passive income. The other point I guess I should make is that the companies that you are investing in, you want to look into if they're good quality companies. In these times, the companies that are established, the companies that have standed the test of time, that have continued to grow even at a slower rate, not 50% growth rates year over year, but maybe 7% growth rates year over year in their top line. These are companies that continue to grow, but slowly. But times like this, they have the capital where they have the reserves to survive, to make it through, and don't rely on outside investment just to survive. And so just now, I think, is a good opportunity for those that maybe are just starting to invest or that are reallocating, to maybe do your research, find those good companies, find those good deals, because they are out there. They are out there now. And don't let inertia of not investing stop you from investing. I think the best time to start is now. It always is now if you're thinking about it, and go and make that plunge, dip your toes in. Doesn't have to be a lot. As you know, Wealthsimple Trade does fractional shares, and that's a great thing. So that's my final note in this video. So hopefully you guys did enjoy. Hopefully you did find some value out of that, but that's the news on what I'm doing currently in these crazy times. I'm going to continue to buy. I'm going to continue to dollar cost average down my positions, but even solidify some of my positions where I can purchase and solidify that cost that I'm already in, so that when I buy high, it doesn't affect the portfolio as much, or that position as much. So again, thank you for watching. Hopefully you did enjoy. Don't forget to leave a like and subscribe, and we'll see you in the next one, guys. Bye.